These hacks have helped me simplify my trading process, save time, and ultimately make more money. So, if you're looking to streamline your trading process and boost your profits, then you won't want to miss out on these valuable insights. So, let's get started. Technical analysis is very difficult. If you don't have some sort of clarity and you don't analyze the right things, you won't last long in the trading game. So, let me share 5 technical analysis tips which will help you make better decisions in trading. No matter whether you're trading using indicators, supply demand, or chart patterns, ask yourself before entering the trade, why would other traders do the same as you? Because market doesn't move only based on big institutes' decisions. Retail traders are also a part of market movement. So you have to think as majority of traders think. One of the primary reasons that many aspects of technical analysis appear to work is self-fulfilling prophecy. Technical analysis tools such as support and resistance, trend lines, measure moving averages, and other types of indicators are predictive because many people base their trading decisions on these same indicators. Using the same information, they take position, causing the price to move in the predicted direction. It's easy to identify a specific price that have previously demonstrated its worth as support and resistance, and the temptation to trade at that price when the level is revisited is strong. I know, I understand, but just think, are the same traders who turned the market before going to be there again? Are the same market conditions present? No, right? That's why you should draw zones instead of one simple horizontal line. Still don't believe me? Here, let me show you some examples. See, now imagine what would have happened if you have entered in a trade seeing those fake signals. Now let's see how zones work. Analyze higher time frames, identify key area, and then simply find your own method of determining which one has a higher probability of occurring and take action. Wait for at least 2 or even better 3 candlesticks before entering into a trade, because as soon as price touches a specific level, many stop losses and take profits hits. So the first candlestick might show you false signal. So that's why you should always wait for at least 2 or even better 3 candles before entering. But remember, don't just go buy after you see 3 green candlesticks. Check which type of candles they are. Are they momentum candles or small body candles? Analyze everything and then enter into a trade. Find your trading style and use indicators according to it. No matter lagging or leading, just master it. Research everything about those indicators. Both leading and lagging indicators have their own set of drawbacks. Leading indicators react to price quickly, which means they can give false signals. Lagging indicators are slow to react, so that's why they have lower chance of giving false signals. But keep in mind, sometimes lagging indicators can give you signal after the trend ends. So you should analyze everything and decide which indicators work best according to your trading style and master it. You should always trade with trend, and to trade with trend you have to analyze the market structure. You can use various indicators to know market trend, for example 200 EMA, 100 EMA, or you can also use zigzag to see the distance between swing highs and swing lows. You can know a lot by analyzing the market structure, so make sure you check the trend before entering into a trade.